just wild. It's worked its way through the system. And everyone seems to be throwing away their old paradigm of last week.
So yes, we had a strong jobs number following a decent JOLTS number, which is a different survey measuring labor demand and supply. And that followed some significant upside revisions to GDP in the US. And so all of that happened, again, against the backdrop of course, the Fed now in an easing cycle and the market, as usual, getting ahead of itself in terms of how much it was going to do. And we can pull up slide 8 here to show that. And so what the jobs data show is that, the Fed has a license to continue easing, but it doesn't need to go, with jumbo cuts to 50 basis points, like all of that stuff. We never believe that anyway.
No.
So the Fed has room to ease. If you look at this chart, core PCE is coming in around 2.7, core CPI is at 3.2. So 2.5, 3 is probably where we could end up on the inflation front, which is still north of the Fed's target, but it is well below the rates of increase that we saw back in 2022, 9% for the CPI. And meanwhile, the Fed is at 5 3/8, or it was at 5 3/8. It's now at 4 7/8. And 4 7/8 is well above 2.5, 3, right? If the real positive rate for a neutral policy is, let's say, 100 basis points, R star, you're looking at 3.5, 4. We're at 4 7/8. So the Fed has at least another 100 basis points that it can cut, not to ease, right? Not that there is a need for the Fed to rescue the economy, but just to reflect the improvements that have been made and to achieve a more neutral policy, much like Alan Greenspan did, a couple of decades ago, back in the mid 90s. And so what the payroll data show is that there is really no rush, right? The economy is fine. It has been softening, but it's fine. The Fed does not need to be restrictive. It can be more neutral, but it can take its time to get there because the Fed doesn't want to go too fast and then all of a sudden it has to walk back on it. It doesn't want to go too slow either because if there's a real need, then it needs to go. But I think it would rather just go big to the downside if it needs to, than to do that prematurely. So I think the Fed is in a good position. We're kind of in that Goldilocks, right? Inflation is closer to the target. The labor market is okay. Rates are now coming down, so the housing market can get a little bit unstuck here. And so, it's all good news.
It's all good news.
As long as the Fed can stop that labor pendulum from swinging all the way from one extreme to another. And that's always the trick.
That's always the trick, and that's what everyone will zero in on for the October numbers, which will be right before the November decision, and that, I guess, is still very much up in the air. The China bazooka stimulus that you spoke about last week is also very much in the markets, and there'll be probably some movement even tonight. We've got markets opening up again in China after a bit of a holiday, so it's going to probably filter through in a new way, would you say? I mean, what are you expecting there?
Yeah, and it's as if the Chinese policymakers, I don't know if you remember back in the Bob Rubin days when if there was some sort of intervention in the currency markets, for instance, they would do it in the most brilliant way possible, just as the market was sort of lopsided, and they would get the most impact from their policy actions. It seems like in China, they've done the same, right? They've waited for the Fed ease. They've waited for this sort of reflation vibe to come back, and bam, now they fire a big policy bazooka, basically. And if they had done that while the Fed was tightening, for instance, it would have fallen on deaf ears, or it would have put pressure on the yuan. But they waited until a perfect time to do it when the dollar is already, weakening a little bit and policy rates are coming down. And we can pull up slide 21, and to show the impact, it's been formidable. And of course, the question that we're all asking of ourselves and each other over here in asset allocation or I should say over there in Boston, is whether this is another false start or whether this time it's really going to get legs. And we've had false starts, right? The reopen trade, remember that one? That really never got legs. So here's the MSCI China index, and you see a pretty big monster move from 54 to 75 just in 2 weeks. That's a big move. The PE ratio at the bottom has moved 3 points, which actually is pretty modest. If you look at all the other rallies, many of them bear market rallies, you got at least 5 points, if not 10 PE points. So the question is, what is behind the stimulus? We know parts of it, of course, share buybacks, facilitating those, lowering mortgage rates, for instance, but some of the policy initiatives have not been announced. That will happen in the October plenum, I believe. And so we're kind of waiting to see what kind of teeth are behind this. But ultimately, when we look at relative performance, and if we pull up slide 20 for a moment, we look at relative performance between, let's say, the US and China, or EM versus DM. You can get these sharp snapback rallies that are really just rallies, and you need to be opportunistic and not overstay your welcome. But the big ones that can last for several years and really generate a lot of excess returns, we don't want to miss those, of course. But ultimately, relative performance follows relative earnings. You see those two lines at the top. That's the relative performance between the US and ex-US and the relative earnings. And they follow in lockstep, and they do so regardless of what the valuation picture is. A lot of people get hung up on, okay, this market's cheap, that market is expensive, but that's not going to move the needle. It will amplify it, but it will not be the catalyst. And so you can see in the bottom, the relative valuation has just kept on moving. So the big question is, these policy initiatives, will they actually make Chinese companies' earnings grow and grow faster than the US? And we don't know the answer to that, but if we go to slide 22, there is some real potential there. And again, there's a lot going on. I apologize for this chart, but this is my...
It kind of looks like a military exercise, like on the seas, there's like a naval, it looks like a boat there.
But these are the calendar year earnings squiggles at the top. And you can see, just like emerging markets and developed markets, earnings have not even surpassed the peaks yet from 2010. I mean, 14 years ago, whereas, of course, in the US, they've been making new highs almost every year. But that's not the point right now. The point is that if you look at that little inset, that is the progression of estimates by year, and it shows you kind of the range that you tend to see. And you can see just how weak the earnings have been, right? That squiggle has been at the bottom of the range. And in the bottom panel, I show those squiggles relative to the US. And you can see the purple shading there is the relative performance, and the lines is the relative earnings progression. And you can see that they generally follow each other, right? So when earnings are positive relative to the US, China outperforms, and vice versa. And so the squiggles are moving in the right direction from very oversold levels, probably the most oversold in 20 years. And so even if it's not a lasting earnings cycle for China, it's coming from a deep enough oversold level, and the market has been so unloved for so long that I think that there could well be some legs behind this, even if it's really just a trade and nothing more. So I think there's some real potential for this to continue. And to kind of tie it back into your question, that would make a sort of US reflation story or broadening story and turn it into a global reflation story, which is what we would used to get after the financial crisis, because China was the big player then. It would do infrastructure stimulus, and that got everything moving from commodities to value stocks to you name it. And so we'll see if it can do that again. But this could now become a global broadening rather than just a US broadening. And especially for Canadian investors who tend to need to look abroad for opportunities, that's an important development.
Yeah, fascinating. And you talk a little bit about this rotation to a global rotation, and where, I mean, we'll come back to some valuation discussions in a second, but let's just stick with this international potential rotation. I mean, I guess I want to ask you where you see the US dollar going short term, long term. We've had this big cut. We've also had some other things go on. So it's a safety place for a flock to safety. The US dollar, though, where does it go a little bit longer term? Tell us about a potential global rotation or to global equities.
Yes. So I'm sorry if I'm looking down, it's because I'm looking at my slides. So slide 9 is the US dollar. So one thing that we've seen that was kind of not predictable, but we could sort of see coming is that the dollar still is beholden to interest rate differential, as most currencies are, right? So if the Bank of Canada eases or tightens faster than the U.S., it's going to have an impact on the Canadian dollar, for instance. Yep. And what you see here is in the purple line is the 2-year yield, which of course is driven by expected Fed policy, right? I mean, that's basically the bond market saying we think the Fed is going to be here 2 years from now, and the dollar is below there. And the yield is sort of like a puppet master holding up the dollar with marionettes. And the dollar had been pushing up against support for the dollar index at 100 at a time when the bond market was maybe a little bit too excitable about how much the Fed was going to cut. And we've pointed this out in recent weeks. And so now, lo and behold, we get the strong employment number. The Fed is expected to cut less quickly and by a lesser amount. That makes the purple line go up, and that made the dollar go up as well. So right now, again, that looks like a massive continuation pattern. And I would argue the next big move is down for the dollar, which again will provide opportunities for non-US investments, maybe not in Canada, but certainly outside the U.S., going to EM and developed markets. But that's a trade that maybe has to wait another day, because right now, as the market walks back the interest rate cuts that were expected, the dollar has strengthened a little bit. And so for now, it stays in that big range. And we'll have to see when those fundamentals change. But interest rate differentials matter. Of course, the Bank of Japan is raising rates. The ECB is lowering them, and rates are being lowered, in most places, including in China now. So it's really a question of the speed and the ending point.
Fascinating. In the meantime, we've got earnings beginning, and it's been quite a year for earnings. You said all the way through the year, earnings really have to deliver, and they have. They absolutely have. Now we look to the third quarter earnings. Do they still need to deliver? I mean, they always need to deliver, but it was sort of crucial to keep the bull market rolling at one stage. And we're in a different phase now. Just sort of put it into context for us.
Sure. So let's go to slide 17. So yes, we've talked about this a lot, of course. The bull market, which began actually just about 2 years ago, October 13th, 2022. So happy almost two-year anniversary there. The first big move of that, as often happens, was expectations of an earnings cycle, but just expectations. And that allows the PE side to really drive the bus. You can see in this chart, this is the S&P, and the blue bars is earnings cycle, and the purple bars or the pink bars is the PE cycle. And you can see that they generally do not move in the same direction at the same time, which is why market timing at inflection points is so difficult, because the market always anticipates, not always correctly, but as a result, the price side tends to move when the earnings side is still going in the other direction. And so the first year of this bull market was exactly that. It was all PE and no E. And then about a year ago, the E started to move, and that allowed the PE side to come back down. But actually, as you can see in the pink bars there, the PE side has actually stayed robust, which is why the performance has been so good, because when the PE goes up and the E goes up, you get an outsized return. And of course, the opposite is true as well. You get super bear markets if both the PE and the E are going down at the same time. We saw that back in the bursting of the dot-com bubble, as well as the financial crisis. But right now, you've got earnings growing, you've got the PE side staying robust. And so the E side needs to come through, right? Because we're looking at things like the inverted yield curve and other indications, that labor market kind of getting frozen right in the middle of a cycle, and whether that can continue. So if there is going to be a recession in 2025, which is not necessarily my outlook, but it's certainly plausible, then the earnings side presumably would not come through, right? And right now the earnings expectations are about 9.5% growth for 2024, 14% for 2025. And so far the earnings seasons have all been good. We're starting the next one basically next week. And if we look at the squiggles over time in slide 18, we can see that the earnings are coming through. They are going up year over year over year. But if you squint really hard at those last few on the upper right, the estimates are coming down, which is very normal. You can see in all of those squiggles that generally the estimates start too high and then they come down a little bit, but the earnings are still growing, but just not quite as much as initially anticipated. So the numbers are going in the right direction, but the estimates are coming down. And if we go to slide 19, we do have one potential kind of milestone in the cycle, and that is that it looks like the growth rate of earnings is peaking. So that's the purple line. And that's not necessarily a bad thing. It just means that, we were in a regime of earnings were growing and accelerating, which creates a lot of momentum. Right now, earnings are growing, but maybe the acceleration phase is ending, which happens in every cycle, of course. So
Right.
so we'll see it. I mean, it's just one data point. Maybe it's premature, but if the earnings cycle is maturing here, then that presumably means that the rate of price gains might be less as well. And again, that might create an opportunity for other regions around the world to kind of show their earnings in their best lights.
But I guess the question is, and maybe the so-called Fed put, or whatever you want to call lots of padding that's in there, will prevent this. But there was a point where companies were getting punished for reasonable earnings, just not blow the doors off type earnings. I guess the question is, with valuations where they are, do you see any reason for that to happen going forward? Things are expensive. You got to out earn to really get the stock to actually hold up.
Yeah, so there I think it's a question. It's sort of a tale of two markets, right? So if you look at the darling stocks, the Magnificent Seven, the AI plays that are trading at higher valuations, and that have become very popular, places to be, there. Those companies have to continuously sort of beat expectations, right? So they have to beat estimates and then raise guidance, and like it's an ongoing sort of cycle there, and that can only last for so long. And then at some point, whether it's Nvidia or some other stock, maybe they only meet estimates and they don't raise guidance, and then at that point, you start shaking the tree of kind of the low-hanging fruit that was just along for the ride. And I think we actually saw that happen over the summer when in July, I think it was July, maybe it was August, when we had that yen carry trade get unwound, right? The Nikkei was down 12% in one day. That unwound these momentum carry trades. And I think that a lot of the tourists were shaken out of the tree, out of the high flyers. But for the rest of the market, which trades at a PE that is 6 points below the cap-weighted index, right? The S&P cap-weighted index is at 25 times earnings. The equal-weighted index is at 19 times. And for those companies that have sort of been held back by rising rates, by tight financial conditions, I don't think they have to really meaningfully beat the estimates or raise guidance. They just need to post decent earnings, and they'll get rewarded, because that's not where the crowded trade was in the first place.
Yeah, fascinating. They're still, in theory, sort of on the way up. A couple of questions rolling in. So this one, Jurrien, if the current bull market is now 24 months old, do you think it could persist for another 18 months? Yeah, we want exact days here. Monday, Tuesday, Wednesday, Thursday, Friday. But what do you think? Length, longevity?
Let's go to slide 4. And so this shows all cyclical bull markets going back 100 years. And the ones in green are during secular bull markets, so prolonged super cycles of above average returns. And the ones in red are cyclical bull markets during secular bear markets. And you can actually see that often cyclical bull markets are stronger during secular bear markets just because they're coming from deeper oversold levels. But the point is, and to answer the question, is that the median length of a cyclical bull market is 30 months. The median magnitude is 90%. So far, we are at 24 months, and the high point was 66%. So you can argue we're in around the 2/3 mark. So I wouldn't say another 18 months, but that's just the median, and you can see how widely disparate the different lengths are. When you look at periods in history where rising interest rates have tended to limit the upside, like we saw over the last few years, as well as the 60s and 70s and 80s. Those bull markets can be a little shorter, but still, we're kind of 6th, 7th inning, and that's something we've talked about in the past. And actually, if I can use the opportunity to embellish the answer a little bit, if we go to slide 5, the length also, I think, is a function of where we are on the secular trend. So again, secular bull markets are super cycles spanning 15, 20 years of above average returns. And I think we've been in one since the end of the financial crisis. So 2009, confirmed in 2013 when the S&P finally made a new all-time high. And actually, if I had thrown out all my other indicators back in 2013, which is 11 years ago, and say, you know what, I'm just going to follow this roadmap, I would have gotten it right to within like 10%, right? So you can see how well we are tracking both the bull market of the 80s and 90s, as well as the 50s and 60s. If we go to the next slide, you can see the same thing in terms of valuation, using here a 5-year price to cash ratio. And again, we're not really at an extreme there either. And if we go to the next slide, slide 7, we also have the CAPE model, which is the cyclically adjusted PE ratio, which the model states that the trailing long-term PE ratio has predictive qualities for the future 10-year CAGR, or compound annual growth rate. And you can see in the bottom there, the orange line is the model. And so 10 years ago, this model predicted that the 10-year return would be about 14, 15%. And guess what? The 10-year return is about 13.5%. So it's gotten very, very close. And this model suggests that the peak of the cycle, which doesn't mean that the market will go down afterwards, but that the rate of change will hit its highest point, will be somewhere in 2026. And after that, the rate of change will start to moderate back towards trend, and then eventually go below trend, as we by then would be in a secular bear market. But that's still a number of years away. So just to add that to the cyclical question and the viewer's question about how much longer, cyclically we are below average still, and secularly we seem to still have several solid innings ahead of us. So my sense is that we still have time.
Right. Fantastic. I love the way that looks. So there's a question about Bitcoin versus gold. I mean, at one point, one was the digital gold, one was the real gold. How do you look at this?
Two sides of
this at this
That's a
point.
great question. I think they are different players on the same team, and we can pull up slide 12. Bitcoin is an aspirational store value. It's aspirational money, and I say aspirational because it still hasn't quite proven itself. It has too many boom bust features, and it's hard to pinpoint one specific liquidity indicator. For instance, here in this chart, I show the global money supply, which is making a new all-time high, by the way.
And so liquidity is wild that's out there right now.
Yes.
Yeah.
And if you think about it, right, we have an ongoing regime of fiscal expansion. That's not going to change regardless of who wins or loses in November here in the US. We now have a Fed that is starting or has begun easing monetary policy. Other than Japan, the rest of the world is easing everywhere. And so that's a pretty potent backdrop for M2 liquidity indicators in general to keep going up. And I think gold is very much playing to that theme. Bitcoin is trying to do it as well. But again, Bitcoin has so many other things kind of going on at the same time. It's still an evolving asset class. There's a lot of sort of boom bust characteristics, and gold is just one thing and one thing only. It's a store of value. Doesn't try to be anything else. It doesn't have to worry about adoption curves and things like Bitcoin has to worry about. But again, they are both Bitcoin. They're both players on the same team, and the baton kind of gets passed back and forth, right? So in 2020, during the COVID stimulus days, it was Bitcoin that really, really ran. It went from like 3,000 to 65,000.
I know, that was nuts.
And it left gold in the dust.
Yeah.
Now gold is having a moment, and Bitcoin is sort of held back. You know, you had all the ETF stuff, and there's a lot of other things going on. And I think they just kind of rotate, and it becomes a substitution trade where, you know, you look at the ratio of gold to Bitcoin, and at some point gold is going to be cheap enough that serious institutional investors are going to say, you know what, I'd rather own gold at this price. But that pendulum may swing to the other direction, and then it will go in the other way. So I like both. I like them for the same reason, but also different reasons. And I think, you know, stores of value, whether it's Bitcoin or gold or real estate or stocks, I think make a lot of sense in a world where you have potentially a move towards fiscal dominance.
Okay, amazing. We just have a minute left. Are you speaking to a whole bunch of investors? You're going to see your fans, I think, aren't you? You're going to see a bunch of them?
Yes.
Hopefully. Oh, good. Good. It should be fun. Let's just leave off on the EM story, back to sort of the dollar, because it's an interesting one, and EM is changing. Emerging markets in some ways have gotten their sort of fiscal houses in order during the pandemic, a little bit anyway, in some cases. India is a fascinating story within this. There's a dilution theme that you bring up recently in research. Tell us about that.
Yeah, so when we look at valuation, right, so the US is significantly more expensive than anywhere else around the world except for India. India is the only country that I know of that is trading at a higher PE than the US. And part of that, of course, is sector composition. The US index has all the big, innovating companies. We all know that story. But part of it is also the quality of the earnings. How much of the earnings are being returned to shareholders via buybacks or mergers and acquisitions. And the US has been a leader on that front with a payout ratio, so dividends plus buybacks minus new issuance as a percentage of earnings is around 70% in the US. And if you just think about it as a net present value question, right, if you get more of your earnings back, that deserves a higher PE. And on the emerging market side, on the other hand, have been on the opposite side of that spectrum. If we go to slide 28, so if you look at issuance of shares versus redemption of shares or retirement of shares, you got EM on the left, the US on the right. The black line is the net between the issuance and the redemptions. And you can see that EM has been always in some form of dilution, meaning existing shareholders get diluted, not diluted like delusional, but no, diluted, I should say, because more shares are being issued than are being retired. Whereas the US, of course, we know the buyback story has been very prominent. And so that's only one factor. Of course, there's many other factors, the quality of the or the sustainability of earnings growth and things like that. But if you look at slide 29, and I know we're out of time, but if we look at 29, and we look at the payout ratio on the horizontal axis and the PE ratio on the vertical, what I'm showing here is China in red, EM in purple, IFA, so developed stocks in yellow, ex-US, so world ex-US in green, and then the US in blue. And, it's not perfect, but you can see generally that countries or regions that return more of their earnings and who do not dilute those earnings get rewarded with a higher PE. And I think that's generally true. So it's just not even a word of caution, but when you're buying EM at the expense of US or what have you, valuations can contract, the spreads can contract to some degree, but ultimately there's a limit to how much that can happen. Doesn't mean we shouldn't be buying emerging markets, but it's just a way to understand the valuation spreads that occur.
No, it's important. It's important because you look at it as an expensive market, but at the same time, there's other pieces that come into the valuation story. Jurrien Timmer, a pleasure to see you. Thank you. Enjoy your time in front of the audience. Glad to see you, and I think we'll see you on this particular channel and program after the week after Thanksgiving. All the best.
Yes. Thank you.
It's Jurrien Timmer.